You take a look at this market reaction. I know that you would have cut rates back in June, but you take a look at what the Fed is facing 2 weeks from today. Do you think that they should go 50?
Well, I've learned in my career to not invest based on what I would do. It's like you got to follow what they're going to do. And listen, I think they should go 50. Do I think they're going to go 50? I mean, we got an inflation report next week. I mean, that's going to be important. Listen, I think they're going to err on the side of doing 25s and stay down the fairway. I don't agree with it. I think the funds rate at 5 3/8. When you've got inflation running, like I said, we're going to get the data. But the last 3 months, you take the high-frequency data, core CPI is running at under 2%, 1.6%. You strip out shelter, it's actually negative. And we know shelter's coming down. 5 3/8 is the wrong price. I think they should get there sooner. My sense is they're not in as much of a rush, and I don't think they learned that much today. You've got a slowly deteriorating labor market, but the slope of the line is just not that intense, and so. Should they go 50? I think they will do, or I think they should. Will they? I don't know.
Rick,
I don't know. I don't know.
To that end, I'm curious about how you see the market pricing adjusting here. If you look at WIRP on the terminal, you have more than 118 basis points worth of cuts priced in through the end of the year. Is the market overcorrecting?
Listen, I think it's aggressive. Yeah, I think it's too much. That being said, I know we've talked about it before over the last couple of months. I like owning yields in the front to the belly of the curve, but I think what has happened is the front of the curve, exactly what you're pointing out, has moved to very aggressive levels. I think what people should do, and we talked about this the last couple of months, we're going to lose that. You've been able to sit in cash at 5 1/4 and just sit there. And by the way, the last couple of years, the trade has been sit in cash and NVIDIA, or cash and AI, or cash and tech stocks. That cash is coming down. And so I like the idea of, gosh, lock these yields in, hold the belly of the curve. I think people will be comfortable. You've seen the last couple of days, all of a sudden it's like, I got to get these yields for a longer period of time. That to me is the obvious trade. And that is the one, like, you can still get fixed income and build a portfolio with yields above 6% because the funds rate is 5 3/8. I mean, I think we're going to be a year from now, people are going to say, remember, we got to do that. That's where I think the trade is.